shouldn't a bank be willing to negotiate on breaking those fixed penalties, those fixed term penalties? So like for example, I got like a COVID rate, right? If I were to go and refinance or want to go and sell my place and then get a bigger place right now, I'm doing them the favor by refinancing right now. Why would they penalize me for that? If they want to keep my business, they're going to end up taking on a bigger mortgage from me at a higher rate. So why penalize me for breaking that? They should be incentivizing me to break it.
But now you need more money because you're upsizing, so you're getting a 4% today, which is great. Like that is a good saving grace for a client instead of paying a penalty on this one. But the challenge now is, guess what? You have two different maturity dates. Your mortgages are not lined up. So it essentially makes it near impossible to move your mortgage to a new lender without having to pay a penalty. So banks and lenders are willing to do those two pieces because you're stuck there. Like there's no way really out of that.
Oh,
So that's what I mean. We're
so
like, no, I know, man. There's like 1,001 different examples of that, but
that's
that
so
it.
sneaky.
Technically, your clients are not paying a penalty, but if they ever were to leave, that penalty is guaranteed.
Wow, that's so sneaky. I never even considered that. That's crazy. So even though they're like, hey, on that next piece of a mortgage, we're going to give you a blended rate so it's even, cheaper. It looks cheaper up front. But
It
now
is
they've
cheaper up front. Yeah.
right, but now they've handcuffed you to them. Welcome to Supply and Demand with Adam Nadler. This is a podcast dedicated to the real estate market in Canada, available now on YouTube, Apple Music, and Spotify. All right, Jeff Mudrick. This is an important one, man. We just saw interest rates come down for the third time in a row, another quarter point. And what is the messaging that we're seeing from the Bank of Canada?
Yeah, I like that. I like that you asked that question because more important than the actual quarter point drop is the fact that the Tiff Macklem says, "Hey, we can see this continuing. We're going to be cautious, but we can see these drops continue. The market's not doing well. The economy is really not doing too well, and they probably have overdone it, which is what everyone was kind of thinking a year and a half ago. But this is why we're expecting to see these rate drops likely continue for the rest of this year. So there's two more announcements, and hopefully into the first half of 2025.
I did see a little bit of like I saw in a couple articles that did the recap that Tiff Macklem did also mention that they're prepared to go with a bigger drop, more than just a quarter point, that they were prepared to go for bigger drops like a half point if necessary. What's your take on that? Because that's that's signaling to the market, number one, not a ton of confidence in the Canadian economy as it is right now. But I guess what do you feel like the reaction is from, everyday consumers that you're speaking to because of that messaging, and how are the banks reacting to that?
From the what feels like 800 people I've spoken with in the last 24 hours, everyone is super interested to see what is to come of variable rate mortgages. If we do see a 0.5%, a 0.75% drop, I honestly believe that would signal more of a reaction, a more of action on buyers, and probably have a bit more properties get thrown on the market. The financial impact for buyers today because of this announcement is very minimal for people who are going out to shop. The reason for that is there's still over a 1% gap between where fixed rates currently are and where variable rates currently are. So, for over, it's like 1.1-ish%. And so to take a variable rate today, you're still spending quite a bit more than if you were to take a short-term fixed rate mortgage, meaning majority of first-time home buyers who are very, very budget conscious, they are still taking that short fixed term mortgage. So the announcement yesterday doesn't have much to do there, but just the conversation, the discussions that we're having are a lot more. Is this a good time? Is things going to pick up like they did in 2020 and 2021? Like, should I get into the market now? Should I wait? Those are a lot of the conversations that I've been having.
How are the banks in particular viewing this? Because they must see the trajectory and think to themselves, well, we'd love to lock people in at fixed rates make more money as rates continue to drop rather than sign people up on variable. So that gap seems a little strange to me, unless it's just that demand for fixed rates and the assurance of a fixed payment is still more palatable to Canadians. Can you talk to me about that? How are the banks viewing that and pricing that?
Banks always make more money off of a fixed rate mortgage because they know what the spread is from the moment they buy, like the bond yield, which is how fixed rates are priced, until for the next like 3 years. Like they have an idea. They know what they bought the money for. They know what return they're getting for the next few years. Variable rates are a little bit different. All banks would prefer clients in fixed rate mortgages with for that guaranteed income. They want like a bit of a spread, but or a bit of a they want fixed and variable, but the percentage is different between each bank based on a whole bunch of different things. But uh, yeah, you got it. Like banks are being very aggressive with three, very aggressive with four, and very, very, very aggressive with 5 year fixed mortgages. And I think they're seeing exactly what you just said. Variable rates will become more popular. They already have in the last month become more popular. And in order to lock clients in, like the banks make a boatload of money on clients in fixed rate mortgages for two reasons. The reason number one, I just mentioned, they know what they bought the money for. They know what their return is going to be for the next X number of years. Number two, though, is just the penalty associated with breaking a fixed rate mortgage is like 3 to 4 times higher than it is with a variable rate mortgage, especially with the big five banks. So um, if banks offer a great discount today, if rates fall and clients are getting offered 4.5 today, rates fall to 3%, and clients want out of their 4.5% mortgage, the penalty to break that is going to be about 4.5, depends, but around 4 to 4.5 to 5% of the balance of the mortgage. Where variable rate's going to be about 1 to 1.5% of the balance. So hopefully that gives a little bit of idea on why banks and lenders are being very aggressive with these fixed rate mortgages.
Right, but can't you negotiate that? Because one thing that I've noticed a lot is I work with a lot of upsizing clients. And in fact, most people in Canada are typically looking to upgrade their living situation, not downgrade it. It's very rare that I see people downgrade their living situation. And in that conversation, normally you have people upgrading by taking on a larger debt load at a higher interest rate most of the time. And so, what I often tell people is you may think that you're going into this, buying and selling and moving situation and that it's a negotiation with, a seller for a house that you want. But really, your very first negotiation, far before that, is actually a negotiation with the bank. That's your very first negotiation. And to be able to keep your business, shouldn't a bank be willing to negotiate on breaking those fixed penalties, those fixed term penalties? So like for example, I got like a COVID rate, right? If I were to go and refinance or want to go and sell my place and then get a bigger place right now, I'm doing them the favor by refinancing right now. Why would they penalize me for that? If they want to keep my business, they're going to end up taking on a bigger mortgage from me at a higher rate. So why penalize me for breaking that? They should be incentivizing me to break it. So talk to me a bit about that. Like how should people be viewing that? Because that seems a little bit backwards to me.
You got it. Like I'll give a pretty good, just easy ways of how banks and all lenders view penalties. Hey, here, Adam. Here's 500 grand at 2% or 1%, whatever COVID rates were. Saw some in the 1% or low 1%. Amazing. We know we have lent you money and we're getting X return, whatever. Like we're lending you money at 1%. Today, if you wanted to break your mortgage, we could lend that same money to somebody else for 5%. So the penalty that you are going to pay is so minimal that there's still a penalty. There might be ways around it, but it's very minimal because of that exact situation. They only they're making such small returns on your investment now. They know they can make a lot more, so you're not paying a huge penalty to get out of that. The challenge in today's environment is any client who purchased in the last 2 years, rates are a lot lower than they were, and they're going to continue to come down. So from a bank's perspective, they're saying, hey, we lent you money at 6%. Now, if you were to break that mortgage, we can only get 4%. So you're going to pay that difference for the time that you have left on your mortgage. So you're going to essentially pay that 2% difference in the form of a penalty for the next 18 months or however long is left.
Right. So the incentive is only there if they can keep your business. Like if you're now if you're now threatening to leave that bank, well then they're like, well, we got nothing to lose.
You know what? Honestly, like I've seen like I can count on the number of the number of times on one hand where a client's got part of their penalty waived. Like there are situations where, from a client's perspective, they might think the penalty is waived, but it honestly is just restructured back into their new mortgage in a we'll call it creative way that the banks manipulate. So the banks know everyone knows how to make money, and because you're getting a deal here, it means probably means you're paying for it over here.
Explain that. Like how would that actually how would that cookie crumble in a realistic or practical scenario?
Oh, every lender has different like ways of setting up mortgages, but for example, one way is, hey, you don't want to break this mortgage, you have or don't break this piece of the mortgage. You're asking for new funds at a lower rate. We'll set you up as a, on paper, it kind of looks like a second mortgage or like a step. So you have your first portion at 6% from you got it a year ago up here. But now you need more money because you're upsizing. So you're getting at 4% today. Um, which is great. Like that is a good saving grace for a client instead of paying a penalty on this one. But the challenge now is, guess what? You have two different maturity dates. Your mortgages are not lined up. So it essentially makes it near impossible to move your mortgage to a new lender without having to pay a penalty. So banks and lenders are willing to do those two pieces because you're stuck there. Like there's no way really out of that.
Oh,
So that's what I mean. We're like, no, I know, man. There's like 1,001 different examples of that, but
that's
that
so
it,
sneaky.
technically your clients are not paying a penalty, but if they ever were to leave, that penalty is guaranteed.
Wow, that's so sneaky. I never even considered that. That's crazy. So even though they're like, hey, on that next piece of a mortgage, we're going to give you a blended rate so it's even, cheaper. It looks cheaper up front. But
It
now
is
they've
cheaper up front. Yeah.
right, but now they've handcuffed you to them.
You have two different maturity dates. So if you sign two 3-year terms and I signed one last year and now I'm getting my second piece, I'm signing it this year. Well, I can't move when my first piece comes up for renewal in 3 years. I can't move just one piece. You have to move the whole thing. And guess what? This piece still has a year, so you're paying the penalty on that. Um,
Right, right. So
mhm.
I guess that's how uh there's so much misleading information in headlines and like when people talk about the huge shock of renewals that's coming and this and that, in practicality, when you're talking about the big five, renewals are not exactly a big deal. And I feel like it makes for great headlines and everyone, projects the market crashing because of these renewals coming up. But explain to people who are watching how that works in real life and what that actually means for people who do have COVID rates that are going to be renewing this year or next year.
The best part about anybody who has an interest rate under 2.5% is I believe it's like 2.24 anyways, but a decent majority of your monthly payment for the last 5 years has gone towards the principal balance of the mortgage. So if your initial mortgage balance was 500,000, after these 5 years, your mortgage balance should be somewhere around like 420, somewhere in that range. So just think about when you initially got your mortgage, the rate was lower. Your rate's going to be higher now, but you're paying a higher interest rate on a smaller mortgage balance. So really, we're not seeing like such huge increases as the media makes it out to be. We're not really seeing that we're seeing some payment shocks. Like it's obviously there, um, but it's not as prominent as what I hear
Well,
on TV.
I guess my question was more about people I guess in these articles that, are looking for clickbait. Um, they kind of make it seem like people can't renew, like they won't be able to renew. But that's not how the big five work. The big five will
Oh, got the
renew you
question.
anyway.
You will get anyone who's coming up for renewal somewhere probably within 2 or 3 months of your mortgage renewing. You will receive a letter from your lender stating, "Hey, here are your renewal options. Sign here to renew. Choose one and sign." And then if you do a little X or a check mark, you sign your name on the bottom. Your mortgage will renew on said date. 99% of the time, you're not looking at documents. You're not. There's no due diligence done by the lender. As long as you have made your payments as planned throughout the previous term of your mortgage, yeah, your mortgage will renew.
Right, because these banks don't actually want to underwrite people again and again and again. Number one, it's costly for them to
Costly.
do it. It's costly for them to do it. They don't want to do that. But also, they don't want to have to deal with a whole bunch of renewals that they can't renew. And now they need to start pushing things to power of sale because people start going into default. That devalues their own asset base, which is their book of assets that they've leveraged, that they've lent on. And so they don't want to do that either. So, really, for them, keeping the party going is what's most important and politically as well.
100%. A mortgage agent on my team sent me this article from just an article from the big five banks that pretty much says something to the effect of banks today are making such low margins on clients first when clients come to um, when clients are oh my goodness, the cost of customer acquisition for a mortgage for a bank for that first term of the mortgage is so costly that banks are truly making minimal profits on that first term because of things like underwriting, because they got to pay their bank rep or mortgage broker. They like no matter whether a client walks into a bank, that person who they spoke with get paid pretty much like similar to what we get paid on the broker side. Um, because the cost to set up the admin, like all that, it's very costly. And there's like a rate war going on between lenders right now. So most lenders will match each other's interest rates, and it's just going to be which lender is going to offer that cut first. And all these other lenders are going to continue to match. So there are these rate wars. This is from an economist at RBC saying rate wars are happening. Um, we hope to get better margins in the mortgage portfolio at some time, but it may be for a longer time than expected. They're going to see these very low margin returns on that first term of client's mortgage, which is really good for clients, really good for the everyday consumer. Um, but yeah, it's just really interesting what's going on.
So basically, people should be really looking at this clickbait and these headlines with a bit of, taking it with a bit of a grain of salt because it's not exactly what's going on in the actual real world of mortgages and renewals.
Yeah, I would say that's you know how it is. Everyone knows how media works. Um, Take it with a grain of salt for sure. Talk to somebody who might have the same opinion or different opinion, who could confirm or deny. I don't think the TikTok. Sorry if you do this. I know you don't, but the TikTok dancing realtors who would throw our mortgage brokers who throw some of this stuff out there to take that information as completely accurate would be you'd be doing yourself a disservice.
And that's why we have this podcast. So I thank you very much for your time. I know that you're super busy, especially because there was just an announcement yesterday. So you've got a lot of work on your, I'm sure, on your desk right now. So
So do
um,
you, my friend. We do together, right? Yes.
we do a lot. There has been definitely, again, this is completely anecdotal, but it just feels like, from my perspective, that the starting pistol was definitely fired. And a lot of people are kind of jumping in to see what they can make happen for themselves and their family. Because it's just been so difficult and so much friction in the market for the last little while that finally now the easing up and the light at the end of the tunnel is spurring a bit of activity. So yeah, let's get to it. And I thank you so much for your time. Appreciate it as always. If you enjoy this content, please give us a like if you're watching on YouTube. Hit that subscribe button down below and make sure to tune in next time. Thanks so much, Jeff.
Awesome. Thanks so much for having me.